Welcome to Multiple Perspectives. I'm David Lofgren. For me, one of the most compelling aspects of the alternative investment space is the sheer variety of asset classes. And while the variety of offerings on the Equity Multiple platform is in and of itself impressive, I'm not speaking exclusively about the alternatives that we bring to the market. I really mean to say that the alt investing space as a whole is filled with fascinating opportunities, from Warhol originals to rare Saint-Emilion Bordeaux's to very recently legal cannabis dispensaries. The self-directed investor has more opportunities than ever to diversify and decorrelate their portfolio. One such asset class that's taking the alternative investing space by storm is farmland. That's right, I'm talking about those amber waves of grain. My guest today is Artem Milinchuk, founder and CEO of FarmTogether, a platform that delivers investors opportunities to invest in farmland all across America. Artem, welcome to Multiple Perspectives.
Thank you, David. Good to be with you.
I'm wondering if we can just start, if you can give me a brief bio, tell me a bit about your journey to founding FarmTogether.
Yeah, absolutely. So I think, my story is very typical in the sense that I was just looking to solve my own problem and to, take a step back. For 10 years before starting FarmTogether, I was in finance with a focus on food, agriculture, and farmland. And a lot of that time was spent in the investing world. And to me, especially working for a large pension fund, farmland seemed just like a perfect asset to add to one's portfolio. Especially looking at the volatility today, how crazy the markets could be. Farmland just looked like this holy grail of stable, inflation, recession-resistant, long-term cash flowing asset class. And as I started looking into that, both for myself and for my friends, for the sort of professional portfolios, I saw how few options there were to invest in this asset class. And it's a massive $10 trillion market. And so really it was like looking at this and going like, wow, there's no way this will not become a huge new investable asset class, especially given new alternatives increasing in importance every year. And after spending about 12, 18 months just really researching the market, because at some point it just seemed too good to be true. But it really is that attractive. I took the plunge and in early 2018 started FarmTogether.
Sure, yeah. I wonder if you could just sort of give me the basic value proposition of investing in farmland, how that fits into someone's portfolio.
Yeah. So, broadly speaking, when you're building a portfolio, especially if you're building a portfolio to meet your financial goals, there's certain proven methods that have shown to deliver attractive risk-adjusted returns versus kind of blindly trading in the market or chasing the latest hot trend, following the crowd. And those lessons are that a well-diversified portfolio allows you to substantially decrease the risk while still maintaining attractive rate of return. When you add an asset class that is uncorrelated with anything else, which farmland is generally uncorrelated with almost any other asset class, an asset class that is long-term and cash flows, meaning that you don't really need to rethink it every year, rebalance it. You want to have part of your portfolio that is recession resistant so that you have cash flows and resilience of your portfolio valuation during periods of recession, which farmland does really well. In the last financial crisis, is what was up something like 23%. In this crisis, it's been flat where markets at some point were down 20, 30%. So from all those perspectives, adding farmland to your portfolio just does wonders to the overall portfolio composition. And then on a standalone basis, it's actually quite attractive as well. So typically, we see and target returns of 7 to 12% with cash flow of 3 to 6, 8, 9, and even 10% and more sometimes. And so even from kind of that standalone perspective, if you think about investing into something you can hold for the next 20, 30, 50 years, farmland is almost uniquely positioned in that regard. And there's very few, if any, honestly, investments I can think of that you can come back to 50 years later and it's still sort of the same thing, probably. Bridges decay, buildings change, cities come and go in vogue. Tech companies, 20 years ago, the companies that exist today are completely different. But farmland, we look at farms, and some farms that we look at have been around for centuries, literally. So it's just really nice to have in this world, especially of rapidly changing technology, politics, climate. We should talk a little bit about climate as well, of course. to an asset class that is just stable, invest and forget, will not give you a heart attack like the latest GameStop stock or crypto or whatever, Dogecoin, whatever is the vogue
Right. Yeah.
vogue
So
these
so
days.
so is that typical of the investments that you offer, that the terms for those are much longer term investments than you might see in other alternative assets?
So in terms of the hold period, actually, most of our farms right now 10-year hold. We do want to gradually increase that hold period because we think that farmland is well suited for a long-term hold. But right now, most of it is 10 years, which I would say is a little bit on the longer side versus some other alternative investment platforms. But one thing that we're doing, working actively on right now to address that liquidity constraint that some investors I'm sure will have, is to have a liquid secondary market. And we actually did a pilot, a small pilot last year that was very successful. About 20% of our first offering was sold out in a matter of minutes at a very small discount to the net asset value. So we firmly believe and see this in other asset classes, in other platforms, that secondary liquidity can be achieved. So ideally, while your farm might be held on the platform for decades, but you could trade in and out of it maybe almost quarterly, maybe even daily, who knows.
Right. There's this interesting tension in the alternative investing space that, of course, the stability of alternative assets comes from their illiquid nature, but investors still want some degree of liquidity. I'm wondering how the pitch for specifically a sort of crowdfunding or a marginal shares opportunity for agriculture uh, jives with people looking for, investors looking for sort of short-term returns, or potentially something that is cash flowing in nature.
Yeah, absolutely. So within that kind of realm of farmland, it's not a homogeneous space. You have different types of deals and different types of risk return. Um, and some deals require development, some opportunities. So for a few years, you don't have any cash flow. Some deals will be immediately cash flowed straight away. But overall, I would say that we're not trying to be everything for everyone. We are the kind of boring, stable, the salad in your portfolio diet, if you will. Um, so we definitely encourage people to think about the investments long term in years, and the secondary liquidity is there. Life happens, but not really to go into a deal thinking that in a year it'll be up 20% and you'll sell. I think that's a wrong way to think about it. We have very high conviction in the farmland asset class performing over decades, and there's huge factors, macro factors that are kind of this irrefutable reality of growing population, improving diets, decreasing supply of farmland that drive the price of farmland. But in the short term, volatility happens, and I would definitely, for our investors that we look for the sort of longer term investors who are looking for stability and cash flow. So if you're looking for that short term kind of boost and gain, we probably will not be the best fit for you.
Sure. I'm wondering where FarmTogether specifically fits into the agriculture investing space. I have a
Mhm.
feeling that most investors probably don't really understand, broadly speaking, how investment in the agricultural industry works. So, can you talk about just sort of where you fit into the spectrum, and maybe how you're differentiated from other platforms that are doing similar things?
Yeah, absolutely. So, when we think about investing in agriculture, you have kind of two broad areas where you can invest. So, one is directly into producers of farmland products. So, this would be the companies that benefit from the agriculture cycle, and that sort of have that exposure to the volatility of the price of the commodities. And that's actually a more volatile and more risky proposition. But when you look into the farmland real estate space, then it's really is like investing in real estate, where your return comes from buying the land and then renting it out to a farmer or contracting it out to a farmer. And so depending on what setup the opportunity has, sometimes you'll have full exposure to the commodity prices, and sometimes you'll have very little exposure to the commodity price, where you're essentially collecting like a fixed rent.
Sure.
So it's different types of products. And so I know sounds like I'm contradicting myself a little bit because I just said, in the first case, the volatility of the kind of commodity producers and commodity exposed companies can be quite substantial. And in farmland, actually, the historical volatility has been less than 7%, which is very much in line with real estate. And the reason for that is that when you own the farm, well, you do have that volatility of cash flows depending on your pricing a particular year, but you have amazing downside protection from the core value of the land itself. And the land itself isn't valued on the year one cash flow, but it looks at the long-term commodity prices that is expected for decades. And those prices have an upward trend. So that's why farmland historically for the last 50 years has increased in price by about 5.9% annually. So now we don't expect that perhaps going forward. But there are those long-term factors in increasing the value of the land. And so you get this, I think, really nice downside protection. You're like a really strong potential for principal protection. And then you have that upside of the cash flows as well. So that's kind of how it works in a nutshell. Yeah, and you can, obviously every deal is a little bit different, but we try to make it very simple. So when you go on our website, farmtogether.com, read a particular deal, it'll explain what is the risk profile of this deal, and there's typically 8-9 factors that come into play. What's the expected cash flows? What is the stability of those cash flows? What are the main risks? And so we try to really clearly outline kind of what you're investing in.
So it sounds like if you're, and forgive me because I really am fairly new to understanding any of this farmland investing.
Most people are, so please ask as any question that comes to mind.
Great. Yeah, I'm wondering, so if you're saying that the value of the asset, the underlying land, helps to mitigate risk, gives you that downside protection, I'm wondering how these deals are structured then. I mean, can you just talk about sort of the actual structure of the investment?
Mm-hmm.
Are these like debt investments, or if there's profit participation, is there some sort of combination of places that you fit into the capital stack here? Like, how does that work?
Yeah, absolutely. So we try to make farmland investing very simple and easy, and that means that we want to make the structure as simple as possible. So every farm is purchased 100%. So we buy full 100% the title to the property, and that is put into a Delaware LLC. Then you, as an investor, buy a share or unit percentage in that LLC. So you kind of, together with other people, own the title to the land. That LLC, that farm, is managed by FarmTogether Management that just provides management services. The subscription documents clearly specify the hold period, which is typically 10 years with 2 1-year extensions, after which the farm is sold. So no one has any say in like what happens with the farm, when is it sold, because there's a lot of investors in the farm, so you want to make sure that you have clear view and don't need to vote on every farm every year what's happening, should I sell or not, with like 50 other people.
Sure.
So very clear, very simple. And then in terms of the capital stack, so if it's row crop farms, meaning corn and soybeans, this is typically your kind of the lowest risk, almost people call, sometimes our clients call it kind of better treasury bonds type product. There's no debt there. Yeah.
Sure.
There's no debt there. And then when it's more permanent crops, which is typically your tree nuts, your apples, those tend to benefit from modest leverage. And so we do put leverage on a lot of our deals. But the leverage we secure from just a traditional lender. So there's nothing that the clients need to do. So you as an investor, you come in and you look at the farm. You say, okay, I want to buy 1% of this offering. You put in your dollar amount. You see how many acres you're getting. You go through the process, sign your documents, prove your accreditation. Boom, you're done. And then you can just watch your holdings grow figuratively and literally on the platform. So really, yeah, there's nothing fancy going on with like structures with debt here, debt there. It's really like either equity or equity plus modest leverage.
Sure. Okay. And to be clear, so when an investor is investing in the LLC, what that LLC owns is the property, is the acreage of land. They don't own the tractors and the sorting machines. That's a tenant who's going to come in and rent land to run their operation on top of. Is that correct?
Correct. Yeah. So let me expand a little bit on what kind of farms there are and what kind of farms we invest in. So broadly, farmland in the United States is broken down into pasture land and cropland. So pasture land is where you take your livestock out for pasture. We don't touch that right now. And then in cropland, you have your row crops and permanent crops. And so the infrastructure you're talking about, whether it's your tractors, elevators, haulers, shellers, all that is a separate infrastructure that is typically not kind of within the core farmland space. So what you might expect, kind of the most in terms of what we call improvements, capital investments, is irrigation, wind machines, tiling and drainage for row crop farms, maybe a bridge here and there, some road improvements, but really nothing. If you're imagining sort of a agricultural processing facility, that would be a completely separate thing. So we really we even try to stay away from buying properties that have houses like lodgings on them. So it's really coming back to our mission of democratizing, simplifying farmland investment is just make it very simple, both the investment product, the financial structure, how it's managed, how you get your money. And so the most of the time what you're buying is dirt or dirt with trees or bushes on it.
Sure. And then so how do you with that in mind, how do you underwrite these prospective deals? What does that process look like?
Yeah, how much time do we have? So it's quite a process. Just taking a step back, I mentioned that my background is kind of in the capital market space, and I'm more of a generalist, as in I understand a lot of the different sectors within agriculture, understand how they all work together, and how that translates into the language of portfolio building, language of capital markets. But in our team, we have people that are specialists in particular verticals. So our investment director worked at Prudential, which is one of the oldest, largest farmland funds in the United States, institutional quality fund. And so our investment process is really very rigorous, very disciplined, and increasingly more and more tech enabled. And so broadly, the way the underwriting works is that we start with a big picture. So we look at climate and what is the potential impact of climate, negative or positive. Sometimes it can be positive on this area, this region. We then look at the end markets for the commodity being farmed. So if we're investing in almonds, what is our view on the almond market broadly? What is the supply demand? What do we think about the price? And we like to underwrite the farms that don't really project, some rapid increase in pricing for no reason. We like to underwrite a price that is sort of at or below historical averages and have strong thesis of why the demand is growing and how the supply kind of matches that and what it means for the price. And so that's kind of sort of a annual or semi-annual exercise that we do to make sure that we have good view on the macro. And then macro also includes, of course, things like trade wars, trade relationships, interest rates, so all those things, inflation. And that's kind of a company-wide, portfolio-wide underwriting that we undertake. From there now, getting to the interesting part is we start looking at which farms, which sectors do we want to invest in. So if you're investing in farmland, especially permanent crops, there's no way to escape California. California produces more than half of fruits and vegetables, more than half, almost I believe 70-80% of tree nuts in the United States. And so it's a massive market.
And again, so permanent crops are what, like things that grow on trees, something that requires sort of a longer establishment period, but then produces year over year without replanting. Is that right?
That's exactly right. Yeah. So, permanent crops is something that's there permanently or for a long time. Row crops, it's planted in rows, so it'd be your corn and soybean, some vegetables. So that requires replanting, leafy greens. And then if you have an almond tree or cherry tree, apple tree, those things last 25, 50 years. And so that requires a different approach to underwriting and different approach to partnership with the farmer, of course. So and the way we underwrite is then start looking at things like the local area, which is water. Number one is very important in a lot of places. Or in other places, what is important, but in a different way, which is too much water, such as Midwest, where you need to think about tiling, drainage. How do you get the water off the farm?
Right.
After we get comfortable with water, which is a big factor in a lot of ways, when you invest in farmland, especially in California, you are indirectly investing in water. So if people want to think about how do they get exposure to the water, I mean, farms are one of the best ways to do that. And then we look at the price, of course, because buying and investing in real estate, price matters a lot. So we look at comparables, we look at discounted cash flows going forward, at the cost replacement approach. So how much will it cost us to redo this from ground up, to triangulate a price that we think is fair. And from there, we kind of build out a model, and increasingly becomes automated, a model of everything that goes into farming. So it's like costs that include labor, equipment, fertilizer, water, utilities, all those things, to come up with a fairly robust model of what this farm looks like, what it looks like under different scenarios. Do we feel comfortable with those scenarios? And then all that is put into an investment deck that then is presented to the investors at a webinar, together with kind of a more simplified web page talking about the key factors of the investment. So it's really, at the end of the day, if you think about what a farm is, it's kind of like, how much stuff can it grow? That's what really you're trying to get to. So in some ways it seems complicated, but in other ways it can be quite simple. Not easy, but simple. Sorry, I know that was a lot, but it's an important
It's great.
point.
It's great. And like I said, this stuff is fascinating. Actually, I have a question that I probably will cut out of the interview, but I want an answer to it anyway, because you're here. Maybe this is way too in the weeds, but so when you own the farmland under an orchard, do you own the trees, or does the operator own the plant from the graft on, or something? Like, how does it actually work?
Interesting. That'd be an interesting structure, but no, you own everything. So you own the land, the trees. The operator, the way it works, in the permanent crop space, you have operators that do this now as a business. So what they do is mostly contract operate farms. And for them, the benefit is that they don't take any of the risk of like budget, costs overrun, weather. They just want to do what they know well, which is farm to the best of their abilities, and what happens, happens. And so it's a different business.
Right.
Today, most farming is done by families. About 60% of farmland is farmed by farmland owners, and 40% of farmland is rented.
Interesting. Okay.
So, and then the farmers that are kind of staying behind, the kids especially, that are becoming more and more professionalized, some of them still own the land and they farm it, but you carry all the risks there, right? Essentially of everything.
Right.
And you also can only spread your asset base over so many acres. That's why farmers prefer to rent, because they can spread the asset base, the equipment, as you said, the talent, the labor, the knowledge over more and more acres. So it's a very scalable business done right. And so the farming kind of businesses we work with, which still very much family businesses, what they do now, so for example, one of our operators, Greenleaf, they operate on a contract basis where there's certain specs, like this farm needs to be operated and particular specifications, and they get paid a fixed fee. We're looking into doing like a success fee as well, but a fixed fee per farm. And for them, what it does is that now they're strictly kind of professional operators without having to think about the weather, what's going to happen with the price, how should we think about the overall input costs, should we buy, sell this land. So there's a lot more that goes into it that is kind of they don't have to take a risk on.
Interesting. They're sort of like the property management company, but they are not participating in whatever the profit from the crop is. They're just sort of essentially hired to do their job, which is efficiently grow apples or whatever.
Correct. Yeah, and also don't carry any of the risk as well. So it's actually they've been their business for decades, and that's how this business operates. And it's again just a much lower risk business versus taking on all the commodity risk.
Interesting. It seems like, from my reading, it seems like you guys tend to focus quite a bit on permanent crops as an asset class, if you can call it that. Why is that? What's the why have you developed that as sort of one of your niches?
So it's based on the experience that our team has, and mostly in permanent crops. We actually do have a strong partner in row crops, but permanent crops, first of all, typically have higher risk return profile, which we found is a bit more attractive to the types of investors we've been working with. It's more complicated, and so it benefits more from our expertise, where we can address that complexity while capturing potentially higher returns. And then it's also the more specialty nature of this market and the leading kind of uh, leading nature of a lot of those industries. What I mean by that is that they're, if it's again an almond industry, it's a massive player in the space. So we like kind of being in markets that are sort of commodity, but where US has some sort of an upper hand.
I'm wondering if you can talk a little bit about the future of farmland investing, sort of where you see your industry going over the next, I don't know, 5, 10 years. It seems like there's a lot of opportunity here. My understanding is that there's about to be a huge turnover in farm ownership or operation. What do you see coming for farmland investing?
That's exactly right. So the driver in this market opening up from the supply side is the farmer aging. So the average age of farmer is approaching 60, and a lot of kids don't want to stay back and farm. And so because of that, about 70% of farmland is expected to change hands in the next 20 years, which is just an insane amount. I mean, it's 100 billion a year is our estimate. Um,
Wow.
yeah, and so a lot of that is, it's important, first of all, to keep it as farmland because farmland is disappearing, to keep it as farmland. For farmers that do want to kind of stay back and keep farming it, we also are exploring solutions to help finance them to keep the farm in the family, because oftentimes what we found, for some reason, two kids don't want to farm, and then the other two want to cash out. So how do you properly navigate that? How do you allow the farm to stay in the family if the farmer is looking to do that while helping the other two receive kind of the cash out of it? And then I think there's a big trend towards sustainability in farming, regenerative farming, that we want to actively drive as well, working with farmers to kind of adopt new standards, helping them take on that risk of transitioning to organic or sustainable regenerative farming. So there's a lot going on. I mean, I think it's going to be a very exciting market in the next 10 years.
I wonder how doing this kind of work impacts the way that what you see when you drive through farmland or what you see when you sit down at a restaurant for dinner. Like, do you just see commodities and market dynamics in every meal you eat?
No, I try to unplug sometimes as well. Otherwise, it can go crazy. Yeah.
So I think, most of the listeners to this podcast are either current or prospective real estate investors, as that's, the offerings that Equity Multiple surfaces on our platform. And I'm wondering if you have any insight or could help frame farmland investing in the context of an accredited investor who has existing exposure to real estate or other alternatives.
Yeah, no, great question. And that's why I'm excited to talk with you today, David. Um, Farmland, I think, is part of this broader trend of alternative investments opening up, which provide that uncorrelated, diversified exposure to new asset classes. And especially with the stock markets going up quite a bit, it's important to also look for new streams of income for the next 10 years. If you read, for example, JP Morgan and their research, they say that classic 60-40 portfolio, stocks and bonds, is expected to only yield something like 3.5% annually in the next 10 years. So with the markets kind of are where they are, you have to start looking elsewhere if you want that alpha, that kind of better returns, uncorrelated returns. And the sort of fundamental truth about investing is that if everyone knows something is a good investment, then it's already not a good investment because it's been bid up in price. So you always have to take some risk. And so alternatives is that place where There's not yet developed financial markets, so there's plenty of opportunities. It's still very much private, which allows for that more custom negotiated transaction type that allows you to capture additional alpha. And so whether it's secondary investment into stocks, whether it's real estate or exotic cars or farmland, we're really excited to see the space opening up. We hope that people kind of add a little bit of this, a little bit of that to their portfolio. I mean, we're of course not saying farmland should replace your core stocks and bonds, but we think that a few percentage points of farmland would be helpful to your portfolio. Not investment advice. That's just kind of how I look at my portfolio and how I think farmland falls into that category of sort of diversifiers and also again inflation and recession resistant, same as I think a lot of other alternatives.
Well, Artem, I really appreciate you doing this. I've learned a ton, and I'm sure our listeners will as well. Thank you so much for coming on the show.
Thank you, David.
Thanks again to my guest, Artem Milinchuk, and thanks to you for listening to Multiple Perspectives. Don't forget to subscribe to the show in your podcast app of choice. And for more information on the current offerings available on the Equity Multiple platform, we've got links in the show notes. For Equity Multiple, I'm David Lofgren. See you next time.